Hey, it's Owen here with Owen Finance, your gateway to smarter investments, sharper financial insights, and also the ever evolving world of crypto and much more. Ready to level up your financial game? Let's dive in. Imagine you're sitting at your desk, staring at a stock chart on one screen and a company's financial statements on the other. You're wondering if you should trust your gut about the rising trend lines or dig through more balance sheet data until your eyes glaze over. If you felt that confusion, welcome to the eternal debate of fundamental analysis versus technical analysis, the two pillars of evaluating stocks. One says, numbers and economic forces drive the market. The other whispers, look closely at the patterns. The chart never lies. Let's dive in and see how they each aim to make you, maybe, a bit smarter about your investments. Fundamental analysis, in simple terms, is about figuring out a company's real, intrinsic value. It's like being a detective who combs through every inch of the suspects, the companies, past records, current performance, and future outlook. You'll look at annual reports, quarterly updates, press releases, leadership teams, and even the broader economic climate to decide if a stock is undervalued or overvalued. The idea is, if you can gauge the true worth of a business, you can compare that worth to its current stock price. If the price is lower than your estimation of its fair value, you might have a good deal on your hands. If it's sky high compared to what the company is realistically worth, you might want to run for the hills. But how do you know that fair value? You start with things like earnings per share, price to earnings ratio, and a flurry of other measurements that sound intimidating until you realize it's basically like online dating. You have to sift through 1,000 data points to see if there's a good match. P/E ratio tells you how expensive or cheap a stock is relative to its earnings. EPS shows you the profit allocated to each share. Price to book ratio indicates how the market values a company compared to its accounting book value. These metrics act like first date questions. Do you have a job? A stable income? Any shady debts? If the answers start raising red flags, say a ridiculously high PE ratio that suggests the company is either overhyped or planning to discover the next magical fuel source, then you might want to swipe left. Once you're comfortable with those basics, you'll step up the game by looking at macroeconomic factors, interest rates, inflation, unemployment, overall GDP growth. They all have a sneaky way of either propping up your favorite stocks or stomping them into the ground. For instance, if interest rates rise, borrowing becomes more expensive, which can hurt businesses that rely heavily on loans. High inflation can eat into profit margins and discourage consumer spending. And if unemployment is high, fewer people have disposable income to spend, which can shrink revenues for a lot of companies. In other words, fundamental analysis isn't just about staring at a single company's numbers, it's also about reading the mood of the entire economy. Sometimes you can have the greatest company on earth, but if the broader economy is taking a nosedive, good luck expecting its stock to soar. Fundamentals will tell you not just how the company itself is doing, but how external forces might be nudging it around. Now, let's contrast that with the loud cousin at the family gathering, technical analysis. Proponents of technical analysis say, who cares about balance sheets and macroeconomic data? The price chart says it all. They believe that all relevant information is already baked into the current price of the stock. Rather than playing detective with corporate documents, they study patterns, historical price movements, and trading volumes to predict where the price might head next. It's a bit like fortune telling, but with charts instead of crystal balls, and if you ask them, they'll say it's more science than mysticism. You'll see them pulling up candlestick charts, line charts, bar charts, you name it. They'll talk about RSI, MACD, and moving averages like they're discussing last night's football match. RSI, Relative Strength Index, is a fancy way of saying, is this stock overbought or oversold at the moment? MCD, Moving Average Convergence Divergence, tries to gauge momentum changes. Moving averages help flatten out day-to-day price fluctuations so you can see a clearer trend. If the 50-day moving average crosses above the 200-day moving average, some technical analysts pop the champagne. If it crosses below, well, they might start shorting. It can feel like a whole new language, and to be fair, it kind of is. Then there's the essential idea of support and resistance. Picture a ball bouncing between your ceiling and your floor. The floor is your support line, where the stock price keeps stopping its fall and bouncing back up. The ceiling is your resistance, where the price keeps hitting its head before it falls again. Technical analysts are basically measuring how many times that ball hits the ceiling or the floor before it breaks through. Once it does break through, they're looking for a new floor or ceiling. It sounds almost too simple, but these levels can be self-fulfilling prophecies. Enough people believe in them, so they trade on them, and that behavior creates the very patterns they're expecting. At this point, you might be wondering if one method is clearly better than the other. Here's the slightly controversial part. Neither side can definitively prove that it's the superior approach for all scenarios. It's like arguing whether coffee is better than tea. Some days you want a latte, other days a calming cup of chamomile. Fundamental analysis is fantastic when you're taking a longer-term, buy-and-hold approach. If you believe a company is undervalued, fundamentals help you see the potential for growth over months or years. Technical analysis, however, can provide you with short-term insights, like spotting a breakout or a reversal pattern. Some hardcore fundamentalists will tell you that technical analysis is just pattern-based guesswork. Some hardcore technicians will say that fundamental analysis is slow and backward-looking. Both can be right and wrong, all at once. So, how do you actually use them in practice? You could stick to one method, sure. If you're an investor who wants to plow your money into a company that's likely to grow over the next 5 or 10 years, you might prioritize fundamentals and simply keep an eye on broad market trends. But if you're the type who gets a thrill from trading more frequently, or if you believe the market can turn on a dime based on investor sentiment, you might favor technical analysis. In reality, though, many seasoned investors use a blend of both. They'll pick a company that's fundamentally strong and then fine-tune their entry and exit points using charts. Think of it as a balanced meal. Fundamental analysis is your main course, and technical analysis is the sauce that adds flavor. An example of combining both approaches could look like this. Let's say you love a certain tech company's fundamentals. They have growing revenues, a manageable debt level, and a product that's basically the new black. You also see that interest rates are steady, inflation is moderate, and the broader economy isn't about to collapse, so the macro backdrop is supportive. But you don't just buy the stock any old day. You wait until your technical chart suggests that the price has found a stable floor or has broken above a key resistance level. Maybe you also notice a bullish crossover on the MCD, which hints that upward momentum is building. By combining these insights, you reduce the risk of catching a falling knife, which, in human language, is buying just before the price keeps dropping. Of course, sometimes fundamental analysis and technical analysis completely disagree. Picture this scenario. The fundamentals say a company's undervalued, but the chart is in a vicious downtrend. Or the fundamentals are iffy, yet the chart shows an unstoppable uptrend. Contradictions are a reminder that markets can be irrational in the short term. You might be right about the fundamentals, but the price can keep tanking because investor sentiment is sour or some big player is dumping shares for reasons unrelated to the company's health. Conversely, a stock with questionable finances can keep defying gravity if there's enough hype behind it. This is where you need to decide whether your conviction lies in the story the fundamentals tell or in the trend that the chart displays. If you're a beginner, it might be wise to dip your toes into the fundamentals first. Knowing how to read financial statements and understanding basic economic forces can save you from investing in a doomed enterprise. Once you can confidently interpret a balance sheet, you could start learning to read charts and apply a handful of technical indicators carefully. Don't just start adding every indicator you find to your chart. You'll end up with a kaleidoscope of lines that confuse more than they clarify. Pick one or two, see how they work in real markets, and adjust as you go. After all, nobody becomes a Wall Street wizard overnight, and trust me, even wizards can lose money if they get lazy or overconfident. It also helps to have some sort of plan or strategy. Sure, reading about both analysis methods is fun, but if you don't have a plan, you're basically throwing darts in the dark. Whether you're more fundamental or more technical, know your risk tolerance, set some goals, and have an exit strategy. For example, if you buy a stock because you believe in its long term growth, set a mental note that you won't freak out over short term dips. Alternatively, if you're trading a breakout, decide in advance where you'll place your stop loss so you don't watch your account bleed if the trade goes south. Plans might not be exciting, but they can save you from emotional, impulsive decisions that usually end in tears. In summary, fundamental analysis is your investigation into a company's actual worth by diving into financial statements, management quality, and economic headwinds or tailwinds. Technical analysis is your close study of price patterns, trends, and indicators on the assumption that the market psychology is written all over that chart. Both have their merits, both have their quirks, and both can fail if the market decides to be unpredictably chaotic. A good chunk of investors and traders find a middle ground, merging the best of both worlds, while others pick a side and stick to it religiously. Neither path guarantees you'll buy a yacht next year, but you'll at least have a more structured approach than just throwing money at a random ticker symbol. And if you ever find yourself deep in a heated argument with someone about which method is best, just remember, whichever one actually makes you money in the end might be your personal winner.
Thank you for watching. If you liked the video, don't forget to give a like and subscribe to support us. If you are interested in our premium content, please also visit our Patreon. You can find the link in the description. Thank you, and take care of yourself and your finances.